Every one of those buyers just got kissed goodbye. This is the kiss of death. The final trap ICT traders wait for before the real move even starts. And if you have ever entered a breakout that instantly reversed on you, you've been kissed out. Let's break down exactly why. I'm Imran, founder of TradeX. Today we're going deep into one specific ICT concept, the kiss of death or KOD. This isn't a random pattern. It's built directly on liquidity and market structure shift concepts we have covered before. If you are new to those terms, don't worry, I'll ground everything as we go. Here's the core idea. In ICT methodology, price doesn't move randomly. It's drawn towards pools of resting liquidity. Stop losses, breakout orders, take profits sitting just beyond obvious highs and lows. Before price finally delivers its real directional move toward the liquidity, it often does something deceptive first. It engineers one last sharp counter move into a key level just enough to trigger a fresh wave of retail entries in the wrong direction. That final touch, the wick that taps the level, looks like confirmation and pulls in late traders. Is the kiss of death. It kisses the level of one last time right before it kills the position of everyone who just entered on it. This connects directly to drawn liquidity. Institutions can't fill large positions without counterparties. They need the market flooded with opposite orders to execute efficiently. So before price truly commits to a direction, it often sweeps an obvious pools first. Equal highs, equal lows, a trendline breakout point. Here's what makes the kiss of death specific. It typically shows up right at a premium or a discount PD array, an order block, a fair value gap, or a breaker sitting close to the origin of a prior displacement. Price taps that array just convincingly enough that it looks like a valid entry signal. Then it fails hard. This is inducement dressed up as confirmation. The kiss is the market giving late traders exactly the signal they were watching for right before punishing them for it. So how do you avoid being the one who gets kissed and instead trade the real move? 4 things in order. 1. Mark your high time frame bias first. Know which side liquidity is being drawn to before price even gets there. Without this, you can't tell a KOD from a genuine reversal. 2. Watch for the sweep at PDRA. When price taps an order block, FVG or breaker that sits against your high time frame bias, treat it as suspect, not confirmation. 3. Wait for the market structure shift. This is non-negotiable. A wick alone is not a signal. You need a lower time frame break of structure confirmation and reverse back in the direction of your original bias before you consider an entry. 4. Enter on the retest, not the impulse candle. Once structure shifts, price often returns to retest the order block or FVG left behind. That retest, not the first explosive candle, is your actual risk-defined entry. Here's the mistake I see constantly, and I've been made it myself. Traders see the kiss, see price tap a perfect level, and enter immediately on the wick. No structure confirmation, no retest, just hope. That impulsive entry is the kiss of death, working exactly as designed. The setup isn't dangerous because it's hard to see. It's dangerous because it looks like every other well-laid setup you have been trained to take. The only difference is whether structure actually confirms it afterwards. Skip that confirmation and you are not trading KOD. You are volunteering to be its next signal. If this made the kiss of death click for you, subscribe. Next video, I am walking through 3 real KOD examples on the chart, tick by tick, so you can train your eye to actually catch this live. If you want direct mentorship through concepts like this, not just videos, the links in the description. Comment below, have you ever gotten kissed by a setup like this? Tell me what happened. I'll reply personally. See you in the next one.